Hi, good evening, everyone. This is Jason Maida with American Pacific Mortgage, and really excited you get a chance to join us for our California Dream for All Shared Appreciation Loan Program info session. We did one of these again last year. So in 2023, when kind of the 1.0 version of California Dream for All came out. So we're excited to bring this new content to you. And, really the purpose of today's discussion is for you to kind of help learn a little bit more about the new guidelines that were just published with the CalHFA Dream for All Shared Appreciation Loan just on last Thursday. So we're gonna kind of share with you a little bit more about what we know. And we just had a lender call with CalHFA yesterday, so we have some new information that was passed along to us. But I really want to help you better understand the CalHFA Shared Appreciation Loan. In case you didn't know, we're the #1 provider of CalHFA loans across the entire state. So our team not only supports the Dream for All program, but also supports things like My Home and the ZIP Assistance program with CalHFA. So we're a proud partner of CalHFA and really feel privileged to be the leading provider of the programs all across the state of California. So whether you're in Northern California, you're in Central Valley, you're in Southern California, we're here to help support you with your CalHFA resources, as well as other first-time homebuyer programs. Now, this video that we're sharing with you today, this will be on YouTube. And we would encourage you to like this video if you really like the content that I'm sharing with you this evening, and subscribe just to make sure you're up to date with all the latest events that's going on with CalHFA, as well as other programs that are available to you as a first-time home buyer. Just a little bit more about our team here. Some of you that are joining tonight's class may be existing clients of ours, or maybe new clients that just maybe stumbled across us, maybe through our work that we already do with CalHFA or on some of our social channels. But we're based out of Sacramento, but we do all of our work via video with our clients. So when we think about consultations and designing plans for our clients, we do all that work from our local offices here in Sacramento. We are a CalHFA lending hero. So being the top producer with CalHFA, we feel like we really understand these products, and especially with California Dream for All, it's really important to be really an expert on these programs to help you successfully navigate through this home buying process. And we have a team here of experts that were designed and just here to help support you on what's really going to probably be one of the biggest purchases you make in your upcoming financial futures. And kind of going forward, we do have other classes that are available to you. So if you like this class, of course, again, click on the like and subscribe to all the other classes. But if you visit us at mortgageeducate.com, generally once a week, we teach first-time homebuyer classes all across the country. So we'd encourage you to check out some of those classes as well. So CalHFA, just so you understand what CalHFA is, CalHFA is the California Housing Finance Agency, and it was established in 1975, designed to help support low to moderate income households. CalHFA is just about a couple blocks away from our offices here in Sacramento, and a lot of future clients have just kind of come to know CalHFA through the CalHFA Dream for All program. But CalHFA does so much more. There's help they do in multifamily housing, low-income housing, and residential housing for both low and moderate, as you're aware of with some of the California Dream for All products. So as we move through tonight's class, I know the big thing we want to learn and kind of understand more about is the Dream for All Shared Appreciation Program. We're going to definitely go through that. I also want to share with you some other programs that are offered through CalHFA. The Dream for All program is a lottery-based program. So now, while we're all really super excited to learn more about the program and to get our application submitted for registration, it is a lottery-based program. So I think it's important to understand that, even though we apply, we may not get access to the funds. Well, let me share with you a little bit about what the Shared Appreciation Loan Program looks like. Well, what it does is it provides up to 20% of your sales price in assistance, or $150,000, whichever is less. Now, that's different than we saw in the program last year when it was at 20% with no cap. So now we're capped at $150,000 or 20% of the purchase price, whichever is less. The funds can be used for the down payment and or the closing costs. So you have an option if you don't want to put, let's say, any money out of pocket, you can take that 20% down, maybe scale it back to 17%, take the other 3% remaining, maybe use that towards closing costs. When we think about purchasing a home, we do have down payment, but we also have closing costs. So we want to have to factor those into our overall kind of budget of out-of-pocket expenses. Now, this is an equity share agreement. You're going to learn a little bit more about that later on in tonight's session. But if you access the full 20% in funds from the program, then the state would have not only a 20% shared appreciation loan with you, but a 20% stake in equity on an ongoing basis. Because I think that's really important to understand, because a lot of future home buyers using this program think it's quote unquote free money, but it's not the case. You have an interest-free loan offered with the state, but then you have a shared equity arrangement with the state as well. And again, I'll show that to you in just a minute. Now, the max contribution that you can put out of pocket, and this is another change that was made to the guidelines this year, is that you can only have up to 5% of your own funds used towards the transaction. So what that would look like then, if I'm going to buy, let's say, a $500,000 house, 20% in the shared appreciation program would be $100,000. If I want to add additional funds to the program, the maximum I can put out of pocket is 5% of the sales price, which would be $25,000. So in that scenario, my max out of pocket would be $125,000, or my total down payment, I should say, would be $125,000. So the shared appreciation program is not a forgivable loan. It must be repaid when you either decide to sell your home or you refinance in the future. Now, there is a one-time exception for refinancing. Obviously, we're not in the lowest rate environment, although all that being said, rates are a lot lower than they were than in, say, October of last year. But there is a one-time refinance option where what that basically means is you can refinance the home, not have to pay back the shared appreciation loan at that time, to enable you to have a much more improved budget if you decide to, refinance to lower your overall rate. Now, another question that we get often on the program is, what happens if I buy my house for, say, $500,000, home values go down to $475,000? Do I still have an appreciation agreement with the state? Well, if your home goes down in value, then there is no equity to share in with the state. However, you still owe the 20% back from the shared appreciation loan. Okay, so something to keep in mind. We'll go through an exercise on that in just a second. You must occupy the property for 12 months minimum as your primary residence to partake in this program. If you have any intention on trying to, do something different with this program, this is definitely not the program for you. This is designed to help create affordable and sustainable home ownership for a primary residence for a first-time buyer. The interest rates for these programs are very competitive, but they're not released yet. They will not be released until later on this year when the program officially goes live. To give you an example of what today's interest rates with CalHFA are, in the last week to week and a half, they've ranged from 6.375 to 6.625. Typically, with the CalHFA conventional loan, those rates generally are about 0.25% lower than market rate that you would find on a standard conventional loan. So it will be a great opportunity from a rate perspective. At least that's what we've seen in past products. There is what we call 2-1 buy down options that are available to you if you do want to partake in that. However, that has to be paid by the seller. Just give you a quick an example of what a 2-1 buy down is. That's when a seller is contributing funds to your financing to help you bring down your rate, basically, in year 1 and year 2 of your loan. So if your start rate of your fully amortized rate is 6.5%, and you do a 2-1 buy down, that means your starting rate would be 4.5, then you would go to 5.5, and then 6.5. I'm not seeing as many 2-1 buy down options right now in this market, given the limited inventory that's available. We'll talk a little bit about market conditions in a bit, because I think it's probably appropriate with the timing of the launch of this program and in terms of when it will probably be available. In terms of the milestones you can expect as a buyer using this program and kind of next steps, if you will, what we would encourage you to do is get connected if you haven't already done so, to review your options on this program, to make sure, one, is you're eligible, Two is let's make sure that you have a good sound plan that this is the right fit for you. And if it is, then the output of a consultation with us will be to issue your pre-approval for the Dream for All program. Every lender that is an approved lender, and you, by the way, you do have to be an approved lender to offer this product. So this is not offered through non-CalHFA lenders. For approved lenders like us, we will issue a pre-approval that is on the CalHFA pre-approval letter template. That is also used upon registration for the program. At this point, we don't know when registration will open up. There's discussions that it will be sometime in April or perhaps May. But in the meantime, if this program is a good fit for you and you qualify, there's a couple things that we would recommend doing beyond meeting with us for your consultation and pre-approval. So one is pre-approval. Two is we would encourage you to start working on your CalHFA required education. We'll have the links for that education available to you as part of tonight's class. We'll also have those on our website. You can find those available on our Homebuyer Resources Hub. There's 8 hours of online education, plus there's also shared appreciation that's required on this program. Now, assuming the registration opens up sometime in spring of this year, so maybe April or May, you will then go in and complete a registration form. You will answer a series of questions, and then the registration platform, from what we've been told, is supposed to be open for about 25 to 30 days. So whether you're the first one to enter the portal or the last one to enter the portal, it doesn't make a difference. This is not a first come, first serve product. It's completely lottery based. So the person that enters first versus the person that enters last has the same chances of qualifying for the program because it is lottery based. Okay, one thing I just forgot to mention when we launched into tonight's class is this is a free flowing conversation too. So questions come up as we move through a lot of this content. So if you do have questions from our class, please feel free, use the chat. You can just type your question in the chat. I'll do my best to answer the questions on air. Again, keep in mind too, I'm sharing with you what we know is public information. We don't have any additional insights to the program other than what has been shared with us in our experiences with clients so far. So, and if you've got your hand raised, that's great. Please feel free to go ahead and answer your question in the chat, and then I'll grab that question as quick as I can. Okay. So question was, are there a maximum number of loans that will be offered? So there's a maximum number of vouchers, which there's an allocation of $220 million for the program funding. There's 9 different regions across the state that each have vouchers allocated. The numbers I believe we heard yesterday, that it will serve about 17 to 1,800 families in homeownership. Okay. And question was, can this be used on new builds or condos? So the answer is yes. So new builds is a little tricky because if your new build is 10, 12 months down the road, there's only a certain timeline. Usually it's about 4 to 5 months that the reservation can remain on these programs. At least that's what we saw last time. We'll get more information about that when the program launches. But at this point, construction would have to wrap up in about 4 to 5 months. Condos are allowed, single families are also allowed, and then manufactured homes can be allowed as well, but the manufactured home has to be on land that is owned, so it cannot be in a mobile home park or anything like that. One of the questions I got earlier today during one of our Dream for All consultations was purchasing land. You can't purchase land. You can acquire a property that has land and a manufactured home as long as it's newer than 1976. That's completely allowed under the program. Okay. All right, great question so far. Let me show you a quick example of how the program works, just kind of matching up a standard conventional loan versus the Dream for All program. So let's take a purchase price of $450,000. If you haven't attended one of our classes, we'd encourage you to do that. But what we do in our classes, we walk through scenarios like this. So if you bought for $450,000, you put 3% down, which is the minimum for a first-time buyer using conventional loans. That would be $13,500. And then we have closing costs, which are 2 to 3% of our purchase price. So Realistically, if we bought traditionally with a conventional loan, we probably would need 22,500 to somewhere around $27,000 out of pocket, right? Now we take that same scenario of home, we use now the Dream for All program. We have a $450,000 purchase price. Now we have a potential allocation of 20% for the Dream for All shared appreciation loan, which is $90,000. That can either basically fulfill my full down payment requirement, and then I would put closing costs out of pocket, or like we said earlier, maybe we allocate some towards our down payment, the remaining to our closing costs, for we have basically no out of pocket option. So there's a variety of different ways that we can do this. Of course, when we meet with you for your consultation, if you haven't already done so, we'll kind of walk through what's the optimal scenario for you given your financial resources. Question was, is in the chat, do we recommend to complete the homebuyer education before registering for the California Dream for All program? I would recommend starting at least the 8 hours of online education, because what we found last year is so many people signed up for the 8 hours of education, and then it caused a little bit of a backlog with the certification call. That is one of the things you have to do after you've completed the online version. So I don't think it hurts, especially with a little bit of time before the program launches, for you to start working on that 8 hours of education. Okay, great question so far. So now let me walk you through a shared appreciation example for how Dream for All would work. And so this is important to understand, because again, this isn't free money, as I mentioned earlier. This is an opportunity to acquire homeownership, but we're also having a financial stake from CalHFA to help support you with the access of these funds for your down payment. So let's say I purchase a home, my home purchase is $500,000. We have 20%, as you can see on screen, which would be $100,000, right? So that still fits the program guidelines. Now, the first mortgage that you would finance would be $400,000. So I have a $400,000 first mortgage. Now I have a Dream for All loan of $100,000. Okay, let's fast forward now. Let's say it's 5 years later, right? That home is now appreciated, and this is just a what if scenario, but let's say that home is appreciated to now a value of $640,000. Okay. Now you go to look at that value of the home. That now your shared appreciation loan is 112,000 plus the 28,000. And how we get to that math is that, or I shouldn't say that. How we get to now what the output of what you would be responsible for is that if I go to sell the home, or if I refinance, let's say the second time, because the first time you do have an option, now I have a payback of the appreciation of my home. So now we're going to have the difference between what I paid for my home and now the home's market value. So now we have a $140,000 difference, right? So now my home has grown by 140,000. 20% of that 140,000 is $28,000. So that's the appreciation share that would be due back to the state. Plus, I still owe the original $100,000 that I received from the state. So that basically means that I have $128,000 that will be paid to the state, which is reflected here, kind of the top of the roof, if you will, of this home. So you have 120,000, but at the same time, I've now accrued 112,000 net equity to myself after paying back the shared appreciation, right? So now we have the loan payback. We have $142,000 in equity, which is, the difference between what I'm receiving of the net proceeds. And now we have we're estimating the balance. This is just kind of projections of what the balance is still owed on the first mortgage of $370,000. So that's kind of taking that first mortgage of $400,000, and over 5 years, it decreases down to $370,000. So that's how the shared appreciation would look. So home goes up to 640,000. We have our 20% that gets paid back on the shared appreciation, which would be 28,000. Plus we still owe the $100,000 for the Dream for All shared appreciation loan. So my total repayment back to the state is 128,000. I get the difference left over after that, and after my first mortgage is paid for. Okay. Now the goal in mind is to say, We get into home ownership, we have this awesome opportunity of appreciation. We have enough proceeds to walk away from the sale of my home and maybe to buy my second home. But the real design of this program is really to benefit buyers that are going to be in their homes 5 to 10 years. Certainly not for an opportunity for 2 to 3 years. It's not going to give you the benefit of the appreciation, because appreciation is not an instantaneous opportunity. Appreciation happens over time. And there are good markets in the housing market. There's not so good markets. Markets will generally cycle every 10 years. And so we can't expect, a home to appreciate 8 to 10%. It may be 1 or 2% or maybe 4%. So I think it's really important to understand that as you're looking at this as your, future investment, and really what's going to be one of your biggest financial opportunities. So this is another example just to show you how shared appreciation works. So we take the same $500,000 purchase price. You can see we have this, growth in value, right? And this portion, it represents, this orange is basically the Dream for All fund. So, the longer you go out, obviously the more equity you're going to have, and the Dream for All fund would still be repaid, but this is pushing out to like 15 years, right? So clearly, if you're at the 5-year mark, you don't have as much equity because there has not been enough appreciation at that point. So it does clearly benefit you as a owner with one of these programs to have a longer term into the loan. Now, there are eligibility requirements for the program, as we've kind of talked a little bit about. So I want to kind of go a little deeper there. The minimum credit score on this program is a 660 credit score for a low income housing buyer. That's someone that makes less than 80% of the median income, 680 for clients that are above 80% of the median income. This is only for the conventional loan product. So a lot of clients that we work with may not be using a conventional loan. It might be an FHA loan or a USDA loan. This is only compatible with a conventional loan. It is also a kind of a standalone product. It does not work with any other community products. So it's just with a CalHFA shared appreciation loan. So, you may have a client that's or might as a buyer have looked at or researched other local products. Maybe it's with SHRA or with it could be with a organization in Orange County or LA County. CalHFA is this particular product is standalone. Other products that we'll talk about just in a bit can also work in conjunction with local city and county products, but not for the shared appreciation product. Okay. So I had a question that came in the chat. Looks like we had an attendee that showed up a little bit late. Yes, we are recording everything. As I mentioned earlier, when we launched in tonight's class, this is going to be on our YouTube channel. So, if you like the information that you're seeing, like us on YouTube, subscribe, because we are going to have further videos that are going to be coming down as we get more information on the program. So DTI, we like to use acronyms in our industry. DTI stands for debt to income ratio. And this is another thing we talk about in our workshops and kind of go through a whole calculation of this. But ultimately what DTI means is your gross monthly income versus your monthly expenses. So on this particular program, we can go anywhere between 45 to 50%. You, as a buyer, you would have to be at least at a 700 credit score in order to exceed the 45% debt to income ratio. Now, another big change that came about with the new Dream for All guidelines is the income limits have changed. Last year, the income limits were 150% of the median income. This year, they're somewhere between 120 and 150%, depends on what county that you're in. We've given you a snapshot of the income limits by county here on this screen. We also have a full list here of all the counties. They're also available on the CalHFA website. This presentation will be available to you. So we'll send out, we have your emails as registering for tonight's class. So we'll send out this complete presentation for you. So you can feel free to click on your respective county to see what the income limit is. And certainly we can help you out with that as well. Now, what's different about CalHFA programs as opposed to other first-time buyer programs, the income limits are based upon applicant income, not household income. And I think that's really important because, as you're looking at this as an option, you may be looking to potentially apply just in your name because of your income level. Well, that's okay, because if you do qualify for Dream for All and you meet some of the other criteria, you can still be eligible for the program as long as you fall within the income limits. So example to that is if I make $10,000 per month or $120,000 per year, my spouse makes, let's say, $80,000 per year, our combined income is over the Sacramento limit of $180,000 combined, right? But if I apply in just my name and I can still qualify, I could still be eligible to purchase in Sacramento County using the Dream for All shared appreciation loan. Now, one of the applicants must be a California resident to be eligible for the program. And the bigger change here is you have to, or one of the applicants has to be a first-generational home buyer. And the definition of that has kind of changed a little bit in different iterations, but we finally have gotten the full definition as of last Thursday when the guidelines posted. And so here's what a first-generational home buyer is. So a first generation is someone, the buyer, who has not owned in the last 7 years and had their name affiliated with a property. So that could be if you co-sign for your sister to purchase her home. If you're on title, you're not eligible for the program. If you have an investment property in Florida, unfortunately, you would not be eligible on the program. So you can have ownership interest in the last 7 years on a property. The other component to first generational is your parents have not current owners right now. So if your parents are current ownership, have a current ownership interest in the U.S., then you're not considered a first generational home buyer. If at time of passing, if your parents are now deceased, at time of death, if your parents were homeowners at that time, that would also exclude you from the first generational qualifying requirement. So that's important. So, you know, those are big changes that are announced with the program. Now, if you have two applicants, one is a first generational and one is not, as long as you have one first generational buyer as part of the application, then you're still eligible for the Dream for All program. So let me just kind of rewind that really quick. So first generational means that I've not had ownership interest in the last 7 years in a property, whether it's co-signing on a property, a rental property, any ownership interest at all. In addition to that, my parents cannot be current owners, or at the time of death that they have passed, they could not have been homeowners at that time. Okay, I'm going to pause there for a second. Is there any questions on that? Because I know that's come up quite a bit as I'm meeting with clients throughout the day about that particular guideline. Okay. All right. Feel free to drop it in the chat if you do have a question. I'm more than happy to answer that, at least is what I know. So that is basically the kind of the high level, if you will, of the guidelines through the CalHFA, California Dream for All Shared Appreciation Loan. Now, again, it is lottery based, and I want to emphasize that because there's also other really great products that CalHFA offers. And being the leading provider of CalHFA, we get a chance to consult with clients on all different products in the CalHFA spectrum. And so I want to kind of just make sure you understand some of the characteristics of some of the other products and where they might benefit you also in homeownership. These can't be added to the Dream for All program, but I think it's helpful to understand these other options too, because when April comes or May and the lottery is launched and maybe we don't get a winning voucher, at least we have a fallback option if you're still considering homeownership. So My Home is a program that works with now conventional FHA, also works with USDA and VA loans, provides up to 3% on a conventional loan or USDA or VA. So 3% of your purchase price that you can use towards down payment or closing costs. And then if you do an FHA loan, you can do 3.5% of your purchase price in assistance. The difference with this program is it's a deferred loan at 1% and simple interest, and you don't have to pay that back until you either sell the home or if you decide to refinance in the future. There is no equity share agreement on that particular program. So, and those program rates are really great right now on the My Home product. FHA rates were as low as 6.125. The conventional program's been about 6.5%. So that could be a really great option if the shared appreciation loan's not a fit for you. So I just don't, I want you to know there is other resources available for you. And the ZIP assistance program provides up to 2 to 3% of your loan amount in interest-free assistance that you can use towards your closing costs. And zip assistance is something that not as common right now because the rates are a little bit higher on that because of the volatility in the markets. But certainly the My Home product can be a really good good option for you as well too. Let me give you a quick just example of My Home and how that can benefit you. So you do have an alternative for you. If we take that same $450,000 purchase price, as we learned earlier, with the 3% minimum down payment, closing costs, we have an out of pocket of about 22,500 to 27,000. If we took the My Home product would actually cover your minimum down payment. So the only thing you would have out of pocket would basically be closing costs, which would be like $9,000 to $13,000 out of pocket. Now you could potentially layer in the zip assistance and lower that out of pocket even further. But I think it's really important to understand, like, it can be an attainable goal for you to reach homeownership even with these products. I know the Dream for All program gets a lot of attention. There's a lot of great media support out there. It's exciting because it's a much bigger option, if you will. But certainly there's other resources available for you as well too. Now, if you haven't attended one of our classes, we always walk buyers through the 6 steps of home buying. Now, I want to take you through these really quickly because I think it's important to understand if you are lucky enough to get a winning voucher or you decide to look at other products, really helpful to understand the process. And I'll kind of just take you through a high level look at this. The 6 steps of home buying look like this. So you have your pre-approval, which you do get that as part of the Dream for All program, and then that allows you to submit your registration when that opens up. But a pre-approval also signifies to a seller that your financing is completely fulfilled. Now, with Dream for All right now, we can't fulfill, or we can issue a pre-approval, but we can't submit offers on the program yet because we don't know if you're going to get a winning voucher or not. So we have to wait till we get the voucher before we would start really starting the house hunting. You may want to just search around on Zillow and Redfin and do some casual looking online, but we really wouldn't want to get serious about making offers until you have an accepted or winning voucher. So step 2 is house hunting. That's when you generally partner with a realtor and look at homes, whether online or in person. Step 3 is now going to be once I have an accepted offer on a house. And so that's when the seller has said, yeah, I'll accept the offer from you. And it starts the escrow time period. What's kind of cool about this new program is that it's not going to be a first come, first serve. It is lottery based. So you're really going to have a much more, just a much better experience, if you will, with just going through your home search. Because what we found last year with Dream for All, because it was a first come, first serve, you had to have an accepted offer with the seller before you could get a registration for funds. And so it created this really frantic buying process, which is not good for first-time buyers, especially when it's your first time, right? So now that you'll know if you get a winning voucher, you're going to have 90 days to conveniently go out and shop for homes without the rush of feeling like you have to find something right away. So you can truly find the right home that works for your family. So entering escrow is step 3. And then that escrow process from step 3 to step 6 is about 30 days. Because step 6 is when we have our keys in hand and we get a chance to celebrate. Like we're there, we're homeowners, we're all good. So that happens at step 6. Now, step 3, we now have the ratified contract. We do have to make a deposit to secure that home. That's another important thing to understand. Even with Dream for All being a fully supported program that can basically cover your closing costs as well, you still will be responsible for making an earnest money deposit, which is usually 1 to 2% of your purchase price as a good faith deposit to secure your home. Now, that is generally protected for you as part of the contingency period. So in a real estate contract in California, you generally have about a 17-day window of time to do investigative work on the home that you're buying. Get the house appraised, which as a lender, all order, you get your loan approved, and then your realtor will generally help you through inspections that you would want to do on the property. And that investigative period allows you to really do the research on the home, because even though you have a winning voucher for the home and you're really excited about this house, it may not be the best fit because of maybe the condition of the property or the value of the property. So those are all important things that you want to do in your due diligence for your home. Step 4 is processing and underwriting of your loan, a lot of the administrative tasks that we do on the loan. And then step 5 is loan approval. And that's where you get a chance to issue your approval. You're probably about 3/4 of the way through the process at that time. It also brings you to the end of your contingency period. And the contingency at that time period will basically allow you to sign off on that as long as you feel like you're comfortable with your appraisal that supports the value of the house that you're buying, that your loan is approved, and of course your house inspections are totally good. So that would take us to step 5. And at step 5, we also issue to you a final closing disclosure. You're going to get disclosures throughout the entire process. There's various iterations of disclosures, but at step 5, we issue to you a final closing disclosure. Gives you a 3-day cooling off period before you move into the very final stage, which is closing your loan. You sign final documents at that time. Any additional funds that you have out of pocket will be wired into what we call the escrow company at that time. Those monies get reconciled, and then recordings happen with the local county recorder's office that you're going to buy in. You would have a grant deed that transfers ownership to you, and then the deed of trust, which is your agreement to repay the loan. So that's kind of what the process would look like. I know most of you didn't attend tonight's class to learn about the process, but I think it's important to understand, like, where do we go from here, right? We want to get pre-approved on Dream for All. We want to register. We want to get a winning voucher, but what happens after I get the winning voucher, right? So understanding that process, I think, is super helpful. Since you have plenty of time before the program opens up, we'd encourage you to come to one of our classes. We have an hour-long class that you can learn more about, not just the buying process, but credit, documentation, budgeting, a lot of really great things that can help you on this path towards homeownership. So we do consultations with clients. That's how we meet with clients. We do video sessions with our clients. Every client that we help through Dream for All, we do a comprehensive consultation. Now, we've shortened those down from 30 minutes to 15 minutes just to create more opportunity to help more people in our community. Now, I will tell you, we are about 2 weeks backlogged in our consultations, but the reason why that is because we're really good at supporting clients in this CalHFA program, but it will not delay you in getting an opportunity to submit your registration, because you have about 3 to 4 months before the registration even opens. So don't be alarmed if you're scheduled out a couple weeks, but it will be well worth your time, because we'll make sure you understand all of your benefits with Dream for All and make sure that it's designed the right way. So when the registration portal opens, you have the best and you have the best team working on your side, but also knowing that you're fully prepared to be able to take on this amazing opportunity for yourself. So here's what a consultation looks like. We do a soft credit check, so you don't have to worry about us impacting your score with a hard inquiry. We're going to still do a budgeting exercise. We're going to talk about where you want to buy, because it will drive the income limits for the program. We're going to look at debt to income ratio, which you heard me talk a little bit about this evening. We'll talk a little bit about your credit, make sure it meets the credit criteria. I'll outline the guidelines, closing costs, and I can't really go too far into interest rates because we don't know what that's going to look like, but I'll give you some perspective on what the market rates look like and some of our projections for some of the economic indicators out there. Okay, so that's what a consultation looks like. That's a little different than what most lenders are going to do, because we believe this is such a big financial decision for you. We need to make sure you're getting the right investments from us as a lender to make sure you're fully supported for this huge purchase. So if you haven't got connected with us already to get your home buying plan designed and work on your Dream for All pre-approval, here's how you get connected with us. First of all, it starts with an online application, and the links are all here for that application. We'll also put those in the chat for you as well too. You'll then upload proof of income and assets, because we have to verify that to validate income for the program. And then you'll schedule a 15 or 30-minute consultation. We have Dream for All specific consultation times that you can, if you're a new client coming to us or a returning client that maybe was trying last year and didn't work, but now is trying to repeat, you can pick one of those options and times. We're doing our best to get clients pre-approved as quick as possible. But again, don't worry, regardless if you meet with us this week or if it's 2 weeks out, we'll make sure you get the same level of care and service that you need to be prepared for the Dream for All registration 3 months from now. You may have learned about our team because of our really cool partnerships that we have, not just in California, but across the country. So you've heard me talk about our classes that we offer once a week. Well, they're through local community partnerships and university partnerships across the country. So if you have friends, family, coworkers that want to learn a little bit more about home buying or the Dream for All program, we'll be hosting classes throughout 2024. We have a full list of our class schedule at mortgageeducate.com. Those are free classes we do just like this. And every one of our classes is all of our YouTube channels, so you can check out some of those past classes over the last couple of years. If you're part of one of our partnerships, we also offer a $750 discount in closing costs to help make homeownership that much more affordable for you. So if you work for the state or maybe you have attended one of our alumni partnerships, you definitely be a participant for one of those discount programs. All right. I know I got some questions in the chat. We're going to get to those in just a second. Here's all my contact information. So feel free to message me with any questions you have. I'll get to those as quick as I can. And, in this buyer experience, I think it's important to understand what it's going to look like. And we have so many clients that we've helped over the last several years with programs just like this. A lot of we're Dream for All clients too from last year. I'd encourage you check out some of their testimonials and experiences on some of our Google reviews. We also like to share a lot of our social on our social channels. We share a lot of our experiences too. And we would encourage you to follow us on Instagram because as I get updates on any type of program launches or I know more about registration for the program, I'll definitely be sharing those on our Instagram. So we're an easy follow at J Meda Mortgage. So it's J Meda Mortgage, and you'll get a lot of helpful content on this journey towards homeownership. Okay. So with that said, I appreciate you hanging out with us this evening. I'm going to answer some questions on air. I'll stay here as long as you need me because I want to make sure you get all the right information for this program. There's a lot of information out there in the social space, online, and unfortunately, there's a lot of wrong information. So I really consider us to be kind of the hub of the right information for CalHFA. So whether you're searching on the CalHFA website or you're working with our team and getting information from our website, it will be the right content that will help support you in this big financial decision. Okay, so question in the chat. My father owned his home in Wyoming, but he passed away in 2019. Does that mean I don't qualify for the program? So the question would be, is if your father owned the home at the time of passing. Because if he owned the home when he passed, then unfortunately that would not meet the first generation qualifier. And then another question was, what period of time history do you need for the review of debts and assets? Do you need student loan info? So what we do is we're going to review the last 60 days of assets for you. There is no asset requirement on this program. We don't look at, how much you have in assets. We would, if you're looking to put closing costs out of pocket, then we would want to make sure you have sufficient assets for that. But there is no limit on the amount of assets you have. And then from a obligations perspective, we are going to do a soft credit check. So the soft credit check will show up any outstanding payments you have, like student loans. Okay, good questions there. Okay, just want to make sure we got all the questions. Okay, and again, I'm recording tonight's class, so Ken from our team will be emailing you out the recorded version and our presentation. But again, we'll have that up on our YouTube channel as well as our full catalog of all of our videos, so you can always kind of check those out. And if we do get more information on the program, like registration information or things that I think might be helpful, we are going to host another class like this. Many of you or many people in our community just didn't get a chance to join tonight because we're kind of trying to get the information out as quick as possible. But as we get any additional information, we'll be certainly passing that along to you and then hosting classes to be able to teach on that as well. Another question was the educational class. It is 8 hours online, self-paced. So that's one version. And then you have to do a certification call with an instructor. You also have to do a shared appreciation online. We'll provide you with the links for all the education. In fact, I think it was actually just put in the chat just now. So you should have that there as well. And then the question just came in the chat. What if I have no info on one of my parents, if they owned or not? So it's to the best of your knowledge. You are attesting to, your level or a knowledge of, kind of your parents being owners or not. It is under penalty of perjury, so it is a pretty important thing to know. So you would want to really do your due diligence to make sure that if your parents owned or not. But it's either or parents. So if you have, two sets of parents, and you're not sure about maybe mother or father, you just would probably want to do your due diligence as much as possible because of just the attestation that you have to make on the disclosures for the program. Okay. And another question in the chat was, if I never refinance and don't sell, hypothetically, when would I have to repay? Is there a maximum? So as we had on screen, I won't go back to it now, but it's basically at 30 years, then you would have to repay the amount of the appreciation loan as well as the 20%. It would not be in your best interest to go the full 30 years because you are going to have more. The appreciation loan will cap out, but you are giving up more. You're giving up more equity because you have a larger sum. So it's in your best interest to try to pay back the loan as soon as possible. So, and those are calculations we can share with you on, more on a detailed basis as part of a consultation. So I'm going to try to answer this question as much as possible. It says, would the total amount be due at once? So if you sell or refinance in the future, yes, the total amount would be due at that time. So there's no payment arrangements to pay back the state because these funds are reinvested back into the CalHFA system. So as clients hopefully sell and refinance, then that's going to create future buying opportunities for the next generation, if you will, of first-time buyers that utilize this program. And as a reminder, there is a one-time refinance exception. So it's called a subordination, which basically allows that appreciation loan not to be due and payable at one refinance. But if you refinance a second time, then that would trigger the shared appreciation loan to be repaid, as well as whatever the equity appreciation is. All right. Any other questions that we have from our group? Okay, so I think we covered this question, but I think it's really important to highlight it again. So this scenario is parents are homeowners, but partners' parents are not presently. How does that work? So again, for the first generational requirement, as long as one of the borrowers are qualified under first generation, then you have potential eligibility under Dream for All. Okay, so if my parents are owners, but my partner, his parents are not owners, they would qualify under the first generation requirement, assuming they haven't owned in the last 7 years, and then we could have potential eligibility on Dream for All. Other question was, how much does education cost for the program? So it's done through e-housing. I believe they're charging $99 for the homebuyer education. All right. Great questions. Okay. I think I covered this again, but I'll try and touch on it one more time. The question is, does asset or cash at bank matter in getting financing? So it does not. I mean, you would need to have enough assets for closing costs if you elect not to use Dream for All for your those out-of-pocket expenses, but there is no cap on assets. Okay, another question is, we sold my father's house before he passed away. This was to pay for his care. Does this mean I do not qualify? Okay, so I think this was a follow-up to our last question. So if the house was sold prior to the passing of a parent, then you could potentially still be considered a first generational requirement. The key in the guideline states that if at time of passing that parent was an owner, then you would not be a first generation. But if the house was sold prior to passing, then you would still be a first generational. I know it's a little nuances in the guidelines, but I think it is important to understand. I just had that exact conversation with a client on my way to the office today. We had a situation where they sold the mother's house prior to her passing, but it was 6 months prior to passing, because she wasn't an owner at time of passing, then she would still be considered a first generation. Okay. I think got one more. So question, what about parents in a foreign country that passed away? That passed away. Okay. Parents in a foreign country that passed away while being a homeowner. So the question's going to be is if they were homeowners in the US. It's all about, did they own property in the US? So if they passed away, they were in a foreign country, but had real estate assets here at the time of passing in the US, then you would not be considered first generation. Okay. And okay, perfect. Okay. Thank you. Okay. I think we got most of the questions. I think we're good. Okay, I think I got everything in the chat. If I missed something, because I know we had a lot of questions kind of coming in pretty fast, please let me know and I'll make sure I get those. Got one more that came in the Q&A. So question is there any condition when one needs to stay in the house for a long time? The requirement is you must be in the house for at least 12 months. And that's also in part of our presentation. Okay. All right. Great questions, everyone. Okay, I think we're good. I appreciate everyone spending a little bit of their Thursday night with us. Hopefully you found this information helpful. And I know a lot of you I see in the class today are scheduled with us for consultation. So I can't wait to get together with you and design your Dream for All program. If you're contemplating taking the next steps in homeownership and want to get together with us, again, we'll get you all the app link information. Really simple process. We'll do a 15 to 30-minute session with you. And it'll be a good investment of your time, and we'll make sure you're well prepared for this journey towards homeownership. So with that said, I wish everyone a wonderful rest of your week. Have a great evening, and we look forward to connecting with all of you soon. Good night.